Everybody, welcome to the live stream. So the reason why we do these live streams is that we know crypto taxes can be stressful, they can be confusing, they can be difficult. So we wanted to make sure that all of you had the information that you needed to accurately report your crypto taxes. So with me today, I got two very special guests. First off, Jordan down below. He is our head of tax strategy here at CryptoTrader.tax. He's also a CPA, JD, LLM, and he runs his own crypto accounting and crypto law firms. We also have Miles Brooks with us here. He's our director of tax strategy, and he has years of experience helping high net worth individuals file their crypto taxes. So I'm excited to get the conversation started. But before we do that, we do have to share a disclaimer. This session is for general informational purposes only. If you have questions pertaining to your specific situation, you should reach out to a tax professional. So to get things started, guys, we are pretty close to the end of the year. Got about 10 days left. So can you tell us a little bit about what investors should start taking into consideration when it comes to end of the year tax planning? We'll start with Jordan and then go to Miles.
Yeah, of course. So I think we've talked about this quite a bit on some of these streams, but the most important thing, at least in my opinion, and what I see on the ground, is allowing people to understand that they have the ability to minimize their tax burden in a plethora of ways. But most importantly, with what we've seen in the market over the last, let's say, 2 to 3 weeks or so, with some price suppression, price depreciation, is we have the ability to harvest some tax losses at year end for assets that have not appreciated in value from the investment, but have gone down. So if you have put a certain amount of money into a certain position and that is now underwater 10, 20, 30, hopefully not, but percentage points, you can sell that position, harvest the tax loss to offset some of that prior year activity that you had, hopefully a lot of gain. The market was very favorable to investors. And then ultimately, if you still believe in that project or you still want to have exposure to that particular asset, you can repurchase it. Maybe waiting a period of time would be a safe thing to do so that it doesn't look like you're just trying to harvest the loss and the IRS doesn't respect that transaction. But that is something that people, specifically at year end, tend to do a lot. There are also people that are doing the same thing, taking profits, and that's why we see a lot of price action at year end, specifically with the crypto markets. So that's one thing that I would obviously advocate for, and that's something that you need to have, a reconciliation software like CryptoTrader.tax or CoinLedger in the future to be able to help you figure out what your unrealized loss positions are. And that's something that might go away. I know we've seen the Build Back Better Act didn't get passed. There's some holdup there, and that's where the wash sale rule change would have been in crypto, specifically for digital assets. And we have a little bit of a holdup there. So we still have the ability to do that. Maybe we do next year, maybe not. But I always advocate to make sure that that's done at year end.
Got it. And before Miles jumps in, a couple things I do want to note there based on what Jordan said. First off, Jordan mentioned our tax loss harvesting tool. Basically, the way this works is that once you upload all your transactions into the platform, CryptoTrader.tax, we'll be able to identify like, hey, this may be an opportunity for you to harvest some losses. Great feature there. The other thing Jordan mentioned is the wash sale rule. So in case you're not familiar, for stock trading currently, you have to, if you want to claim a capital loss and you decide to sell your stock, typically you have to wait another 30 days before you can buy back in. Currently, that rule does not apply to cryptocurrency, but as Jordan noted, that might be changing in the very near future. So before we continue on here, Miles, anything you want to add on to what Jordan said?
Yeah, I think loss harvesting is a great tool, as Jordan mentioned. And I think it's very important for the average investor, especially in crypto, to take a look at what their tax liability may be at the end of the year. Trades are for the entire 2021 tax year are mostly finalized. And think it's really important, especially in crypto where people may not have a lot of fiat or US dollars. They may be illiquid with fiat currency, to start your plan to set aside that money, to have that money available come April 15th when that tax bill is finally due. Knowing at the end of the year, there's no rush to get that money available because you do have until April 15th. But you also may have estimated tax payments for the end of the year as well. So it's important for people to realize what their tax bill will be and to have that money liquid and ready to go to pay the IRS.
Right. I know that's something we did see during the 2017, the first rise in Bitcoin, where people had all these gains during the tax year, but then after the market crashed, they didn't have the money to pay off their tax bill. So,
Yeah, that was a big problem. It was, I think, partially related to the HODL meme, because people thought that their assets were gonna always continue to go up, or maybe go up over a long period of time, right? And that's why they were HODLing. But at the point in time when the tax payments due, like you mentioned, Duraj, if you don't, sometimes people's portfolio value was worth less than what their tax liability was. And we don't want to see that happen to anyone this year. Obviously, in 2022, April 15th, like Miles is mentioning, when you have to make that payment, you do always, of course, want to reserve capital to make those tax payments. Hopefully the market has matured to the point where we don't see that crazy long bearish phase or that crazy price supply shock where we have 50, 60, 80, even 90% drawdowns on some of these alts. But it could happen, right? So you always want to be prepared. I 100% think Miles is right, making sure you know where your tax liability stands. As of now, there's probably not much activity for the rest of the year, like Miles said.
got it. So one last thing I do want to talk about before we head into the questions from the audience is, Miles, I know you and I the other day were discussing crypto donations and how that can be an end of the year strategy as well. Can you tell the audience a little bit about how that works?
Yeah, crypto donations, really any appreciated stock donation, appreciated asset donation is really tax advantageous. If you donate long-term property and it's appreciated in value, not only do you not have to pay tax on all the appreciation, but you also get the full fair market value of a charitable deduction. It's one of these rare double dip opportunities for taxpayers. One thing to note is you really are only claiming charitable deductions if you're itemizing your deductions rather than taking the standard deduction. So these charitable contributions through appreciated assets like crypto is a great way to reduce your liability should you already be itemizing.
Got it. That makes sense. So just so I understand, as a non-tax professional, I guess there's a standard deduction, but if the charitable amount is greater than that, then it's worthwhile for me to use itemized deductions.
Yeah, currently the standard deduction is $12,000, I believe. And so if your combined itemized deductions exceeds the standard deduction, you're going to want to take your itemized deductions. Oftentimes people are itemizing if they own a home, in which case they're paying mortgage interest expense and real estate taxes. Those are other pieces that kind of that go into this itemized deduction list. Which could then, once it's a higher value than the standard deduction, you're going to want to be itemizing.
Awesome. Jordan, anything you want to add on to that?
No, I agree. There are, like Miles said, many different types of deductions in that itemized bucket, and donations being one. And yeah, like Miles was saying, I mean, for married couples, the standard deduction is quite larger. It's obviously double that. It's around $25,000 for the 2021 tax year. So sometimes when you're looking at, state and local taxes, real estate, mortgage interest, stuff like that, you don't get to that level. But in crypto, many people's portfolios have done very well this year. And if they want to contribute to a charitable organization, like Miles was saying, that donation might take them over the top, and therefore now they're itemizing. Maybe they haven't been in that situation before, so that's something you want to be aware of, right? And plan for that, because it can. I mean, of course, it's doing good. You're donating to a good cause, but it also can help you, as Miles mentioned, from a tax perspective, getting that fair market value deduction if you have held on to that asset for a long period of time and it's appreciated in value.
Awesome. Well said. So I know that we do have some questions already from the audience. I also do have a few that we got from Twitter and Facebook. So let me pull those up as well. So here's a question we got from Twitter. How much do I pay in taxes when I'm converting Bitcoin from an old wallet into fiat? So because this person said old wallet, I'm assuming that they probably held Bitcoin for multiple years and seen significant gains. So Miles, we'll start with you this time.
Yeah, the exact amount you pay in taxes really depends on your tax bracket. If this case, if we're assuming long-term capital gains, that percentage paid is going to range from 0 to 20%. Most likely, people are paying 15%, around 15% effective, unless you're getting into higher income amounts, in which case you're taxed at that 20% rate. In addition, if your income is high enough, you may be applicable to net investment income tax, which is an additional 3.8%. Really, to keep that in mind, if you do have that those higher income amounts and you're calculating what you may owe on taxes, you don't want to forget about the net investment income tax of 3.8%.
Got it. That makes sense. Jordan, anything you want to add on to that?
No, I think that's perfect. The only thing that would probably come to mind in that person's situation is they may have been, they may not be able to establish basis if it's like a really, really old wallet, or it's something they bought on, like, I don't know, Mt. Gox or like Cripsy, and then took it offline and they have no access to those data points. I'm assuming this is like you said, an old wallet. At that point, the basis issue is probably nothing. So it's not, even if you reported it as zero basis and you sold something for, like Miles was saying, a few $100,000, if you have a sizable Bitcoin position, the long term, if you had $2,000 of basis and you sold something for 300,000, it's really going to make a very, very immaterial difference. So you want to be conservative with your basis allocation. If you don't know what it is, if you can't figure it out, but you bought this BTC in like 2013, 2014, you could take a position that it might be zero. It won't help you, but you'll have that long-term holding pattern, like Miles was saying, 0, 15, 20, whatever percent, with the potential for the net investment income tax, depending on that position, depending on other, investments and portfolio type income. So I think he covered it.
Got it. That makes sense. So here's a related question that we just got from Eric on YouTube. For those of us who have tons of transactions on decentralized exchanges and didn't manually track each transaction along the way, what's the best way to approach this, especially when those gains are sold on a centralized exchange for fiat? So Jordan, any thoughts there?
Yeah. It's tough because there are a lot of software solutions that you can, integrate with, like CryptoTrader.tax, and when that rolls out, it's going to be a great feature. But there always could be some transactions that aren't populating the way that you think they maybe should, or maybe they're just reading data on chain in a little different way. And if you have a ton of these decentralized exchange activities, whether it's on the swap, from like a swap perspective, or single side staking, rebase tokens, providing liquidity and moving in and out of these positions, whatever that is, there most likely will need to be some sort of manual supplementation to what you're doing for now, until there's a great solution that can encompass everything, which I think is getting built here. But it's just a tedious process. It's a tedious task. So if you're not manually tracking all of the transactions along the way, you could go back in time. That's the great thing about everything living on chain and kind of see what transpired. It does help if you keep somewhat of a log so that you can, jog your memory if there's a particular transaction that you don't remember or you see it and you're like, doesn't look too familiar. But oftentimes, if you have the ability and you have the experience of doing those on-chain analytics, you can get the information you need to figure out what your basis is on those dispositions on the centralized exchanges that you eventually move for fiat. I'm not saying it's easy. It is difficult, but it can be done. But if I think it was Eric who asked the question, if you're tracking that activity along the way, it helps. But even if you're not, there's still a remedy for that. It still can be done. It just isn't I don't want to say it's easy. It's not an easy process to complete, but there are tools that help you facilitate that process, like CryptoTrader.tax.
Yeah, and as Jordan alluded to, we are planning to release our DeFi integration in the very near future, definitely before the end or before the April 15th tax deadline. So that is something to look out for. But Miles, anything you want to add on here before we jump into the rest of these questions?
No, I think Jordan did a great job explaining some of the issues and some tips and tricks for tracking all this stuff.
Awesome. So here's another question that a couple of people wanted the answer to. Can you tell us a little bit about how staking is taxed? So Miles, you want to start this one off?
Yeah. Staking income is, for example, if you're, putting your ETH into confirming the Ethereum network, you're going to be earning staking rewards in ETH. This income is considered earned income and it's taxed at ordinary rates. And it's taxed for when you receive the tokens, and it's taxed at fair market value upon receipt. And it's important to convert that amount that you received into a US dollar amount to be reported on your tax return.
Got it. Okay, awesome. I think Miles covered it pretty well. Unless Jordan, you want to jump in with everything? Okay. So
no, I think the traditional staking structure and how that works is exactly what Miles was saying, and people maybe I don't know if there's been enough guidance from the IRS on certain transaction structures. So it does make sense that someone that's not a tax professional or someone that's not in the space or has a significant amount of staking rewards that they've earned over a period of years and is already familiar with that process would be, unsure of how that's taxed. But it's just that's the nature of the beast here. I mean, maybe there will be a change in the future with some political lobbying, with some pending litigation, some pending court cases on how staking rewards are taxed. At least maybe jurisdictionally could be different, but that's what we're dealing with now. It's like Miles said, it's income upon receipt. Take the spot price, so whatever that is, whatever the fair market value is at the time you received it, that's going to be the US dollar value of income for that reward.
Right. And here's a great question from Kyle, and it's very much related to what you were just saying, Jordan. And it's a question that we receive quite a lot. For staking ETH, do you need to have access to the funds to get that income tax liability? So for those of you who may not be aware, right now ETH2, you are able to stake. However, you don't have access to withdraw or transfer the funds just yet. This is a complex question. Miles, do you want to start this one off?
Yeah, I think this is an area that is an uncertain area. It's hard to give general tax advice, in a forum like this. But I think that being said, this may be a situation to talk to your tax professional because of the uncertainty of how it is to be taxed. There's a case for both taxing the income that you receive through staking, even though it's locked up. And there's a case that because you don't have access to the staked rewards, you don't have control over these assets. There's a case to say that this income is not yours until you have control over those new staked new tokens received from staking.
Right. Yeah. Unfortunately, as Jordan mentioned just now, for a lot of these questions, there is a certain amount of gray area just because the IRS is kind of a few years behind when it comes to the crypto ecosystem. That means, there are some investors choose to take more conservative approaches while some choose more aggressive approaches. So, Jordan, anything you want to add on?
No, I think Miles said it great. I mean, the truth of the matter is maybe there's an argument on both sides, and some people will, of course, want to take the position that favors them the most, which would maybe say that we're not recognizing the income until we have, the actual rewards in our wallet, or have the ability to self-custody them, right, to actually claim those rewards. And I think it's a valid argument, right? But again, just as Miles said, it's so situational. It depends on your situation with your tax advisor, with their tax opinion, based on case law, which there isn't much, based on traditional, tax principles, which we can always allude to. But this is like a whole new sort of transaction structure, not for us in the space, but for the code. There's nothing really codified for how these things work particularly. So I don't think there's really much to add other than the fact that it can, I know it's annoying to say, but it could go either way. You could argue that it is income because it's received and you tangentially have dominion and control over the asset, but you don't really. Or you could say, well, I don't really pick up that income until I actually have, until there's actually constructive receipt, until I actually have the ability to access these funds. And you could point to different things and make comparisons, but there's no real true comparison in this case. So I mean, at the end of the day, that's really what we're looking at from those types of staking rewards. And there's, like we talked about earlier, tons of other transaction structures that create this same sort of gray area issue. And hopefully there's some clarity on that with something, guidance, case law, something in the future. Otherwise, as Miles said, people are going to continue to take, different approaches, and now they kind of collide with each other, and how who's going to be right? Maybe everyone's right. I don't know, at least for now, until there's a definitive, opinion on it. But that's kind of my 2 cents on that.
Got it. Thanks for that insight, Jordan. So here's a question from Glenn. So any advice on how to handle crypto loss with companies that go bankrupt when they were holding your crypto? So Jordan, you want to start this off?
Companies, let me think about this. So you have a company that's going bankrupt that's holding your crypto. I'm assuming, I don't know about companies that are going bankrupt, but maybe some sort of rug pull. That kind of sounds familiar. A company going bankrupt that's custodying your assets, like a Mt. Gox type of deal, that's a little different. You can have to go through this whole bankruptcy proceeding, and it can take many, many years. But I'm not entirely sure what the focus of the question is. But in terms of the first portion, well, the bankruptcy part, that could be very, very difficult and a long process, and it's not fun to be involved in a situation like that. But as far as maybe like some sort of protocol exploit, or some exchange, maybe losing funds, sometimes they can pay you back, right, if they have treasury that can do that. We saw that happen with I forget what the project was a couple weeks ago, where they had an exploit and they actually paid everyone back. So that wouldn't necessarily be a loss. But if you got, were involved in some sort of investment and there was a rug pull and you lost your money, well, technically what happens in that situation is your tokens might be valueless, but you haven't really executed a taxable event to trigger the loss. There's no liquidity in the liquidity pool. They've removed all of that. So it creates this weird issue. I tend to think that you have the ability to possibly write off that investment as something that you entered into for the purpose of having a profit. It's now technically worthless, not like a worthless security, and maybe sending those funds or triggering some sort of transactions that shows that you're kind of abandoning that property that's worthless. But that's completely different than like a bankruptcy sort of proceeding where there's a company that goes bankrupt and they're holding your crypto. That's a whole nother process. That would go through different systems, but you also would have a loss in that situation. You would have, a complete loss of your investment.
Got it. Got it. Well said. So I know we only have a few more minutes left, just because, and we do have a ton of questions. So let's try to get through a few more. So here's a simple one. So Chris asks, will you be integrating various wallets in the future? For example, MetaMask. So I can answer that. Yes, that is on the CryptoTrader.tax roadmap, and it will be coming very soon. We're planning in the next month or two, so do keep an eye out for that. So here's a question that I've been seeing very often as of late. So, um, sorry, let me just make sure I'm getting this right. Somebody asked, do gas fees reduce capital gains? Definitely something a lot of people would have to take into account if they've been using the Ethereum blockchain this year. But Miles, you want to take this one on?
Yeah, yeah. Gas fees, when you make a trade, like you use a Uniswap or you use another swap protocol, gas fees are going to reduce your proceeds received, and it's going to change the capital gain calculation because if you receive less, your proceeds are less. There's less income to pick up, and so when your gas fees are directly related to a transaction, to a disposal, those gas fees will reduce the amount of proceeds you receive. Um, it becomes more complicated if you have other gas fees that aren't directly related. They still may be overall related to managing your investments, but they may not be related to a specific trade. With the Tax Cuts and Jobs Act from 2017, they removed the miscellaneous itemized deductions. They removed the deductibility of miscellaneous itemized deductions, and a lot of those kind of indirect gas costs spent towards managing your overall investments rather than maybe as compared to directly related to a trade. Those are now non-deductible. And so, we've kind of seen a shift in what is deductible. And so the safest way to go is to only deduct those gas fees that are related to specific trades. And in those cases, those fees will reduce your proceed amount.
Well said. Well said. Yeah, so since we're running short on time here, I'll move on to the next one. So some Raw Realm asks, can you review how NFTs should be considered from a tax perspective? Jordan, I know this is a little bit of a complex question. Can you tell us a little bit about the rules and regulations here?
Yeah. So NFTs, there's so much going on from a tax perspective with NFTs because, well, first of all, when you're dealing with art related NFTs, it's different. There's so many different use cases for a non-fungible token. But as far as what we tend to see, right, the profile picture NFTs, the one-of-one art collection sort of NFTs, for the creators, right, for the people that are selling, that's definitely earned income. Some of them may have some sort of entity structure where they're selling and are doing things through a corporation, a partnership, an LLC, whatever. Some of them may be just doing it as a sole proprietor. It's the same sort of income generation for them. They're generating income. It's earned. Most of the time, it's what they do. Sometimes it's like a passion project, but most of the time, these are artists that are generating income and they're paying tax accordingly. When you are investing in these things, they have different sort of consequences depending on obviously what it is. But if it's the type of profile picture NFT that's most likely deemed to be a collectible, then there are different tax rates that you have to consider for long-term purposes. The collectible highest tax rate is 28% for long-term capital gains, as opposed to 20% for like a traditional investment. Maybe some NFTs with utility wouldn't necessarily be deemed to be collectibles. They may be deemed to be investments, so they could get those favorable long-term capital gain rates. But most people that have bought and sold NFTs, at least for now, because the market is still maturing, it's usually a short-term sort of deal. It's usually not very long-term, so they don't necessarily have to worry about that. Early adopters will, when they finally dispose of their punk that they claimed for $20 and they sell it for 1.5 million. Okay, well, that 8% makes a huge difference, but that remains to be seen on what definitively it is. I tend to think that it can kind of go either way. But as far as people that are generating income from creating said art, and we deal with that all the time, it's definitely earned income. It's not necessarily a hobby per se, and you wouldn't want that because there's most likely expenditures that are involved with this, and sometimes expenses outweigh the income in the beginning phases of setting up these operations, and you want to be able to get those losses and carry them forward to future years. So that's technically what we see on the NFT side. There's so much to unpack in that question. We could have a 30-minute conversation specifically on taxation of NFTs, but at a high level, that's typically what we see, and that's typically how things are taxed.
Yeah, wow, that was a really good summary for like 1 minute. Do you guys have time for one last question, or?
Sure.
Awesome. So here's one from Kyle. So what happens when a crypto on an ERC token, on an ERC20 token spins off into its own blockchain? The new tokens are airdropped to the same wallet address as the old ERC20 tokens. I believe Kyle's this specific situation would be like a one-to-one swap, like the old token just got replaced with this new one. So we'll start with Jordan for this one, then go to Miles.
Yeah. So this is a weird situation because it kind of looks like a token swap. Like you might have to do something to actually receive that token. If it's an airdrop, like Kyle's saying, then I would say no. But oftentimes when tokens either change their like ticker or they move across blockchains, you actually have to do something to swap one for one, and it looks like a taxable event. I don't think that personally, I don't think that is. What we tend to do on those situations is roll basis forward and do some sort of conversion and extend the holding pattern, specifically if it's the same project, same protocol, same network effectively, but maybe they're moving chains. If it's an airdrop that you're receiving and it's supposed to be pegged exactly one-to-one, and those prior tokens are deemed worthless because they have zero function anymore, in my opinion, I would probably treat it the same way, specifically if it's moving across networks like Kyle mentioned, from the Ethereum network to some other network. And those ERC20 tokens are in your wallet, but they're worthless. So it wouldn't make sense to just treat that as income, the airdrop, and then move forward with your basis and holding period from there, because that's not really following the flow of the investment, following the flow of the transaction structure. So that's how we would treat it. And I think that's how it should be treated, but there's no definitive guidance on a specific issue like that, because the only airdrop sort of guidance we have from the IRS is when you receive an airdrop, you recognize it as income. But those were based off of 2017 transaction structures where people were randomly airdrop tokens, where we had hard forks like every day. So it's different, in my opinion.
Yep. Well said. Miles, anything you want to add on?
Yeah. I agree with Jordan. One quick note is, the IRS has given that guidance about what is a taxable taxable fork and what is maybe not a taxable fork. Those hard forks more likely to be taxable, soft forks more likely to be non-taxable. And so if we're kind of thinking in that lens, could we relate the situation? Is that more of a taxable fork, or is that more so of a non-taxable fork? It's probably more similar to one of these soft forks than a hard fork, especially if that old network goes away and becomes worthless. And so I would say, definitely a gray area. And this is an area that needs more guidance from the IRS, but it really could go either way.
Got it. Well, thanks again, guys. Miles and Jordan, great insights from both of you. We are out of time. So we are doing this again next month, so I'll see you guys all shortly. But a lot of closing notes here. So if you're having trouble doing your cryptocurrency taxes, CryptoTrader.tax, soon to be CoinLedger, can help. We are releasing our DeFi and NFT integrations next month. So that will be an awesome help to, I know, a lot of investors out there. So if you're looking to catch our next live stream, I'd recommend hitting the subscribe button. Like I said, we do this every month, so you can catch up with us next month. Well, thanks all for tuning in, and I will see you all shortly. Bye now.
Thanks, Siraj. Thank you,
Take
Jordan.
care.